Well, good morning, everybody. Yeah, Dana started like in basically like Marcus and Millichap's like a fraternity, and she was like one of the few women that's kind of survived there. Um, so I work for a company called IPX, or Investment Property Exchange Services. We are a qualified intermediary. We facilitate somewhere between 2,000 to 2,500 transactions every month. This month I closed 196 exchanges for my customers. It was about $400 million worth of real estate. So there are a lot of people that are still transacting and doing exchanges. I think a big part of that is the fact that we've seen such significant gains. In fact, I was just working on a deal right now where I wish I had this kind of a problem, but I have a client that bought a home in Montecito 45 years ago. They paid $435,000 for it, and it was their primary residence. And so, as you guys may or may not know, when you have a primary residence, they're married. They can take up to $500,000 tax free, right? So they bought it for $475,000. They spent a couple $100,000 on it over the years that they've owned it, and they could take $500,000 on top of that, and that's kind of what they can take tax free. Well, the problem is their house is now worth $13 million, right? I guess I would like to have that kind of a problem. So I talked to them about 2.5 years ago, and they said, listen, we are not wealthy people. We bought this home, we stretched when we bought it, and we've just kind of been lucky that this market has appreciated so much. But it represents most of our wealth. And so they refinanced the house. They didn't have any debt on it. They took out $1.5 million of cash. They used that to go exchange into a house, a condo where they now live. And then they've rented the house out for about the last 2.5 years to convert it to an investment property. So when you're doing 1031 exchanges, right, it's got to be property held for investment or business use, right? So things like a primary residence, they don't qualify. A second home doesn't qualify. A vacation home can qualify if you use it for less than 2 weeks out of the year, and we'll kind of talk about that. And you rent it for at least 2 weeks a year at fair market value. So there are ways that you can make a vacation home qualify. We'll kind of get into more of that later. So for them, they said, well, we're going to convert this to investment property. And I just got an email actually today that they are under contract to sell that asset. They're going to take their $500,000 exclusion when they sell, and they're going to take the balance of it and 1031 exchange it and work with somebody like Dana to go buy investment real estate that they're going to use that income to retire off of, right? So something that comes up a lot with 1031, and maybe we should just start right at the beginning. So 1031 is just section 1031 of the tax code, which allows someone that owns property that they've held for investment or business use to sell that asset and exchange it for another property that they intend to hold for investment or business use. It doesn't say you have to hold it as an investment forever, right? But it does say that your initial intention when you bought it had to be to hold it for investment, right? So it allows investors to move between real estate investments without having to pay taxes all the time. And the reason why it's good for the real estate economy, because we almost have lost it a couple times, because they look at 1031 and they go, hey, why are we allowing people to do these 1031 exchanges? Why don't we just let them pay taxes? Well, the reason that 1031 exists is because if someone like Dana or Charlie came to you and said, listen, we want you to sell your duplex or your rental home, and we want you to pay taxes and then use that money to go buy another rental property where you're going to have a higher property taxes and less equity, people just wouldn't sell, right? It creates kind of a lock-in effect. The other thing that it does is it helps local municipalities get additional tax revenue, right? So like these clients that I talked about that own that property for, they bought it for 400 and some odd $1,000. Today it's worth 13 million. Those new buyers, right? When they come in and buy that asset, they're now paying property taxes at what they paid for, right? The old property taxes at 400 and some odd thousand, they were probably paying $5,000 or $6,000 a year in property tax. The new property tax bill is going to be much more significant, right? And so that when they go buy new property, they're also going to pay increased property tax bill. So a question that comes up a lot is like, what am I going to pay in taxes? If I just decide to sell my property, pay my taxes, what does that look like? It's not as simple as most people think. So I get calls all the time from people that go, oh, I know if I sell, I'm going to have to pay 15% in capital gains taxes. I was like, well, I wish it was that easy, right? So there are a couple taxes associated on the sale of investment property. The first one is at a federal level. The federal capital gains tax is 15 to 20% depending on how big your gain is. And without going into the particulars, roughly gain that's less than 500,000, you're going to pay 15%. Gain that exceeds 500,000, you're going to pay 20%. But there's another tax that people don't know about. It's called the recapture of depreciation tax. So one of the advantages of owning real estate, right, is that you can take depreciation deductions on the improvement against the income the property produces, right? It's a huge advantage of owning investment real estate. But when you go to sell it, the government wants, at a federal level, 25% of that back. Right? Now, there's another little known tax. It's called the healthcare tax, or they call it the Cadillac tax. And the healthcare tax is there, basically says if your gain exceeds $250,000 or your income level exceeds $250,000, you're going to pay an additional 3.8% in taxes. Now, who else is going to want money? The state, right? The state of California, we are going broke. We got a budget deficit. They're going to need money, right? The state taxes you on what they call the total gain of the sale, right? So they've got, hey, your property's gone up X amount of dollars in value. You've taken this much depreciation. We're going to lump those two numbers together, and we're going to tax you at whatever your income level is. And your income level basically goes somewhere between, 9.3 to 13.3%. The problem is that if you sell cash out, right, your income level does what? Goes through the roof. Now, right, you're not paying ordinary income taxes on it, but your income tax level goes up. So most people end up in that 13.3%, right? So the idea behind 1031, it allows you to defer those taxes into the next property. Now, it's important to remember these are tax-deferred exchanges, not tax-free. So I had a client about 4 years ago. She sold the property, did a 1031, bought 2 replacement properties, 2 single-family residences. She called me up like a year and a half after she owned them. And she said, hey, Greg, how long do I have to hold these properties before I could sell one? And I said, oh, do you want to do another 1031? She said, no, I just want to sell it and cash out. And I said, well, you could sell it anytime you want. She said, why would they let you do that? I said, why would they let you do what? She said, why would they let you do a 1031 exchange and then just immediately sell the property and then not pay any taxes? I said, who said anything about not paying any taxes? I didn't say that. The taxes are still there. You've just deferred them into the next property Now, there is a way to kind of go from tax deferred to tax free. There was a kind of a loophole in the tax code where you could combine 2 tax codes. It's kind of been closed up a little bit, but you have clients that, 1031 exchange a property into, let's say, a property in, the desert. Let's say they ultimately think they want to retire there. So they own a property here in the valley. They go, listen, I really wanted to retire in La Quinta. So I'm going to sell that property here in the valley, and I'm going to 1031 exchange it and go buy that new property in the desert. Now, the rules say I've got to hold that as an investment, right? I'm selling an investment. I got to hold it as an investment. So the question becomes, how long do I have to hold it as an investment before you think I could convert it to personal use? What do you think? 2 years. So there's a revenue procedure that's 2008-16, which probably doesn't really matter. And in that revenue procedure, it says any property that's been held as an investment for 2 years or more in an audit, the IRS can't challenge the held for investment portion of the exchange. So if I hold that as an investment for 2 years, I can pretty much do whatever I want with it. Now, so let's say I hold it as an investment for 2 years. I then move into it, make it my primary residence, right? Well, the old conventional wisdom would say, well, listen, I know that if I hold it as my primary residence for 2 years, under Section 121, it says that I can take up to $250,000 tax-free, or if I'm married, I can exclude up to $500,000 tax-free on the sale of that property. Well, the IRS kind of closed up that loophole a little bit, right? For a while it existed, and so people were like, just going from tax deferred to tax free. And so what they did was they said, we're not going to exclude people from being able to take that exemption. But what we are going to do is we're going to make you own that property for at least 5 years before you can take your exclusion. And we are going to prorate how much the exclusion you could take based off of qualified use, which is time that you live there, and non-qualified use, which is time that you rented it out. So if I rented it out for 2 years, I live in it for 3 years, then I can take basically 60% of my exclusion, which is about 300 grand. Obviously, the longer that I live there, the greater that exemption becomes, right? So you can kind of go from tax deferred to tax free, right? So another thing that kind of comes up a lot is people that are wanting to become passive owners, right? So, you've owned this real estate, you've dealt with the terrible T's, right? The tenants, the toilets, the taxes, the termites, all the fun things, right? Associated with managing real estate, right? And now you're getting to a point in your life where you're like, hey, we would like to travel. It's kind of like my family with dogs. We have 4 dogs, and my wife's like, once these dogs are gone, we're not getting any more dogs, right? She's like, it's just a lot of work. And she wants to not be tied down to anything, right? And so the idea is, you see people that are going from, management intensive properties, whether it's, rental homes and or, apartments, into looking for passive types of investments where they're saying, hey, I'd like to exchange out of this. I still want to, own real estate. I need the income that the property produces, but I don't want to manage properties anymore. And so we're seeing a fair number of people that are going into these things called Delaware Statutory Trusts, or DSTs. And the DSTs are basically these real estate companies that go out and they buy portfolios of properties. Like there's a company in Pasadena called Exchange Right, and they specialize in buying net lease investments. So they buy a bunch of net lease investments. It could be 30 properties. It might be a $75 million portfolio. And then you could buy a small fractional interest in all of those 75 properties, and then they pay you income every month. They typically have it on what they call a master lease, and they pay you, 4 or 5 or 6%, whatever that thing pays, and you don't have any management responsibilities. So you become kind of a passive owner. It gives you some diversification, but it does make you no longer kind of in control of your real estate. And that, I think, for a lot of us as investors, becomes very challenging, right? Because you're like, I'm not willing to necessarily give up all the control of my real estate. And so when I first started in this business, it was 26 years ago, I knew one person that worked at Marcus & Millichap who sold these things called triple net lease investments. And at that time, the only people that were really buying those were institutions. You kind of remember that, Dana? It was like not really something that people bought, right? But now I probably have 400 customers that specialize in only that type of investment. And you say, well, what's a net lease investment, right? You see them all over the place. Walgreens, Dollar Tree, Jack in the Box, Starbucks, McDonald's. Starbucks, right? Starbucks is in the coffee business. Actually, I found out they're probably really more in the sugar business. But they don't want to own real estate. They want to use their revenue to open new Starbucks, right? And so, but they want to act as a true owner of that real estate. So Starbucks signs something called the triple net lease. So all of the Starbucks that you see, none of them are owned by Starbucks. They're all owned by investors like you guys, right? And so, but Starbucks signs a triple net lease that says, hey, we're responsible for the maintenance in the property. We're responsible for the property taxes. We're responsible for the insurance on it. So the owner of that property, right, they just collect a check every month, and then they pay their mortgage if they have one, and then what's ever left over is there. It's net of all expenses. Now, we had a Starbucks in our local Vaughn's grocery center down, I live in Monrovia. And what is something that you have noticed, a new trend or relatively new trend about all Starbucks? Drive-through. All new Starbucks typically have drive-throughs. So there's this one in the Vaughn's shopping center, right? Well, their lease comes up. What do you think happens? They don't renew it, right? So now it's a See's Candy, with the new tenant. So, they're not completely bulletproof, right? So you could lose your tenant and then have to go find a new tenant. But it is an interesting form of ownership of real estate that you could potentially look into. The other thing that I think that's interesting, so I'll tell you guys kind of a funny story. So my stepfather, when he was alive, owned apartments. And his theory behind real estate ownership was, we own apartments because people always need a place to live. And no matter what happens in the economy, we could lower our rents or we could give away a month free, we can always keep them full because people need places to live, which is good theory, right? So about 20 years ago, we sold the property in Monrovia called Monrovia Villas. And my stepfather, he was in an exchange. And so about 4 days into his exchange, his 45-day identification period, he had a massive stroke. And so I stepped in with a power of attorney to kind of help complete his exchange. At the time, I knew a guy who was the CEO of Home Depot. His name was Bob Nardelli. And I was at the Home Depot Center at a soccer game with Phil Anschutz, who's one of my customers that owns AEG. And I said, hey, I'm wondering if you currently have any Home Depots that we could potentially buy. Now, Home Depot is one of the few retailers that owns, their spaces, right? And so he said, yeah, we're just completing a project in Alabama. It should be done the next 2 or 3 weeks. I can sell it to you. I said, okay, great. Now remember, this is 20 years ago. At this time, nobody knows anything about triple net leases, right? So I close on this deal. My stepfather has no idea what the hell's going on. So 4 or 5 months later, right, doing better, gathers himself together and calls me out of the blue and says, hey, I was just thinking, what happened with our 1031 on the Monrovia Villas property? And I said, oh, we completed it, Dad. He said, oh, great. What did we buy? I said, we bought a Home Depot. He's like, what? He's like, am I going to have to get one of those orange aprons and go? I'm like, no, we don't own the business, right? We own the land in the building. Home Depot's our tenant. He's like, oh, okay. He's all, is it the one down on Mountain? And I was like, no. And he's like, is it the one in Laverne? And I was like, no. And so he's like, where the hell is it? I'm like, it's in Alabama, Dad. He's like, son, how am I going to manage this property in Alabama? And I said, Dad, they don't want a slumlord like you managing their property, right? Home Depot is responsible for the maintenance, the insurance, all that stuff. He's like, okay. But still couldn't get over the fact that it wasn't right there, that he couldn't see it. So 3 years later, he's in Georgia visiting my niece, and he calls me and says, hey, I'm going to rent a car and go drive by that property. And I'm like, okay. So he calls me that night and he said, hey, I went by and checked the property out. And he said, you're right. I said, what do you mean I'm right? He said, it looks exactly like a Home Depot. So it ended up being a pretty good property for him. The bottom line is that I didn't know how he was going to come out of this. So he was buying these, apartment buildings in syndications and partnerships. And we're going to talk about partnerships and how you get out of those and that kind of stuff with 1031s. And so we already had, and he also was managing all these properties. He had a property management company. So I was like, we may have to I don't know how he's going to come out of this, but he ended up coming out of it just fine. So, so there's lots of opportunities for 1031. I think people hear the term like kind with 1031 and think I've got to buy like kind property. What does that mean? And it really is kind of a misnomer because I get clients that get bad advice about that all the time. I had a client not that long ago that called me and said, hey, Greg, I'm in an exchange with you guys. I sold some vacant land and I really want to buy a property in Shell Beach, but my CPA said I can only buy vacant land. And I said, no, that's not true, right? So the rules for like kind when it comes to 1031 simply say, are you selling real estate and did you hold it for investment or business use? And are you buying real estate and do you intend to hold that for investment or business use? The asset class of the real estate does not matter. I had the same thing 2 weeks ago. A client sold the property, wanted to buy a business use property. He was a dentist. And he said, you mean I can buy a dental office and run my business out of it? I'm like, yeah. He goes, my CPA said I can't do that. I'm like, get your CPA on the phone, right? You absolutely can do that. I said, you're going to live there? He said, no. I said, okay, it's fine, right? So investment or business use qualifies. Because we do see a lot of people right now, the baby boomer generation that are getting to a point where they're selling their businesses and there's some real estate associated with that business. So they can exchange those assets, right? The real estate portion of the business sale and exchange it for an investment property. and get something down the road. So like kind, very broad, right? Completely wide open. I just doing an exchange for a client that's selling off some farmland in another state and is buying a property here in California. So, that's wide open. Remember, 1031, federal tax code, we can exchange anywhere in the US, right? Now, California does have a clawback provision. They've always had something that says, hey, we'll allow you to sell property in the state of California, 1031 exchange it, and buy a property in another state. But if you ever sell that property in this other state, we want you to come back to us and pay the taxes that you would have owed when you initially sold your property here. Well, before they had any way to track that, who the hell was doing that, right? So if I, let's say, moved out of California, lived in Arizona, let's say I sold a property in, California, and I 1031 exchanged and I bought a property, let's say, in Texas. Does anybody know what the capital gains tax rate is in Texas? It's 0, right? So I buy this property in Texas. I'm no longer filing a California return. I sell the property in Texas, let's say 3 or 4 years later. Do you think that I'm really going to go back to California and say, listen, I know that you don't know this, but I sold that property in Texas. I'm here to pay you your money, right? Nobody was doing that, right? So California now has a filing requirement that says, listen, we're going to allow you to exchange out of the state, but you've got to file something with us every year showing that you still own that property. And if you ever sell and cash out, we want the money that you would have owed us when you initially sold. Now, I have got an interesting case study going on, and it's been going on for a little bit of a while. So I have a client named Tim who sold all of his California real estate, and he also moved to Nevada. And he bought properties in Nevada, Arizona, Texas, and Tennessee. So when they first came out with this filing requirement, which was a while ago, I called Tim and I said, hey, Tim, I know that you just sold your California portfolio and exchanged into these states. Is this filing requirement challenging for you? He said, well, I'm not doing it. I'm like, well, what do you mean? He said, well, I don't own any more California real estate. I actually bought his last deal he owned in California. And he said, and I'm no longer a California resident. What are they going to do to me? I'm like, I don't know. Let me know how that works out. So he's kind of an interesting case study without knowing that he's a case study. Also, he comes with a pretty funny story. So last year during Christmas, real estate owner, his brother's a real estate broker who I've known for many years. And they were planning a trip to Europe. And he is probably worth, I would say maybe $50 to $75 million. So he has a huge real estate portfolio, right? And so they're planning this trip to Europe. And he says, Jack and I, his brother, are debating over economy plus or first class, right? Because they're like, well, we don't know if we want to spend the money. He has 2 boys that are both kind of involved in his real estate portfolio. So he said, I've never really thought about asking these guys like what they're going to do with the portfolio. So he calls the kids in there and Jack's there. And he goes, boys, I've never thought about asking you, what are you going to do with this real estate portfolio when mom and I are gone? They said, we're going to sell it, Dad. He's like, what? He's all, yeah, we got to step up in basis. So yeah, we're going to have some estate taxes we have to pay, but we're going to sell it and spend the money. He's like, are you kidding me? He's like, I worked my whole life to build this portfolio up. They're like, yeah, we see how you work. We're not going to live like that. So he said, I am never flying anywhere, not first class again. So he's going to try to spend as much of his money as he can before he dies, which I thought was probably pretty good. Yeah. But, I see a lot with that generation, right? A lot of it, right? My best friend, his dad was a incredibly famous doctor, probably one of the most successful neurosurgeons in the country. And he, the other day, took 4 stops on the way back from Atlanta to get here on Southwest just so that he could use his points. I'm like, Daryl, are you crazy? Like, what are you doing? They're just in their DNA, right? I totally get that, right? So the hardest part of an exchange is the identification process, right? So, and when you're doing a 1031, right, the first thing you got to remember is 1, I got to make sure I set it up before my sale closes, right? And so I would say, when someone calls me and says, hey, what advice can you give me about doing a 1031? The best advice can give people is have a plan in place of what you're trying to accomplish going in, right? When you're talking to Dana or Charlie and you're thinking about selling your property and they know that you're going to 1031, they're going to ask you, what are we trying to accomplish by selling this asset, right? Are you trying to build your portfolio? Are we trying to reduce management responsibilities? Are we doing it because we want to buy in a different geographic area? And if you're trying to increase cash flow, what does that look like? Are you trying to increase cash flow and reduce your management responsibilities? So what does that look like, right? So that's number one, right? Because selling an asset simply because it's highly appreciated is a bad idea. And let me tell you, I'll tell you guys a very simple story. So about a year and a half ago, I was at my office and something came up on my computer from Zillow about my house. So I clicked on it and I went, my house is worth that much money? So I called my wife and I said, listen, honey, we got to sell. She's like, why? I'm like, our house is worth this much money. We got to sell it. She goes, okay, fine. Just find us a new place to live. Well, guess what? When I started looking, everybody else's house went up just like mine, right? So it was like, you're trading, you're buying and selling in the same market. You're not selling high, buying low, right? So you're buying and selling in the same market. Now, you are seeing some challenges in the market, right? So we are seeing some cracks in different markets. Big Bear is a market where you're starting to see, inventory levels creep up. I think we're seeing in the desert levels starting to creep up a little bit. So you are seeing maybe some opportunity there. We are seeing a fair number of listings, right? And so, that we have not seen before. For a long time, for a very long time, we have been in an inventory deficit for, I don't know how long. How long do you think we've been in an inventory? A long time, where there was like, no inventory on the market, right? And so that's starting to change a little bit. Now, in markets like this, you don't see it shift that much, right? Because it's so desirable to be here that, and the more desirable the place is to live, the less you'll see an adjustment in the market, right? So, but it's important to go into it with a plan, right? And then once you've decided to, okay, I'm going to go ahead and get the property, listed for sale, and, Dana gets it on the market. As soon as that thing goes under contract and into escrow, once you clear contingencies, if she's looking for your replacement property or Charlie's looking for your replacement property, they're going to start firing you properties. And you want to be aggressive early in your transaction because you only have 45 days after escrow closes to identify the property that you want. And that time goes very quickly. Now, sometimes, like how often are you able to build extensions into escrows? Like 15 or 30-day extensions?
On the sales side
yeah.
of their property? Yeah. I mean, it depends on how good of a deal they're getting from the buyer.
Right. So sometimes you could build extensions into your escrow period where you can back up kind of the starting line and the starting line starts the date that your sale closes, right? So when you're doing an exchange, what happens is prior to your property closing, you hire a company like ours, hopefully it's me, right? And we get your exchange set up. We're going to send you documents to sign. You sign those. When your sale closes, the proceeds of your sale come to us, and I typically will go to Cabo for a couple of weeks. No, I'm kidding. At that point, that 45 days starts. Now, so when your, deal closes, we open up a for the benefit account for you. So it's your money. We're just kind of acting as a custodian. So that 45 days goes quickly, right? Now, during your 45 days, you can make as many offers as you want. You can also get something under contract prior to your sale closing. So if you're 2 or 3 weeks away from closing and you find something you want to buy and you're non-contingent upon your deal, you can absolutely make an offer, get it under contract, right? And there's also something called the reverse exchange, which we'll talk about too, where you buy the property you want before you sell the property that you have. But I am always of the opinion, the faster you can get something under contract, get your due diligence done so you're not butting up against the 45 days, the better off you are, right?
Talk about how you identify, and because you don't want to just, I wrote an offer on this property, so
Yeah.
I'm going to identify.
Yeah, if you get to the end of your 45 days and you have not, you're not under contract on a property, and you just, let's say, identify 3 properties, you put down 3 property addresses, sign it, date it, send it to us, we're in trouble. I would say when you have an exchange like that, where you have not gone under contract within 45 days, I would say that probably more than 50% of those exchanges fail, right? Now, What percentage of exchanges do you think get completed? So of the 2,500 exchanges we're going to do this, actually 2,300 exchanges we're going to do this month, how many of those actually you think get completed? 20%? Ooh, that's a bad rate. 93%. 93%. So only 7% fail. So most people are pretty motivated to get those things done, right? So, it is scary, right? And it's always interesting because, a lot of times we're on, the consulting side. It's not our personal deal. So it's like, oh, no, we'll get you through it, whatever. And then when you do it yourself, you're like, oh, this is stressful, right? So I did an exchange 2 years ago where I sold a property in La Quinta, was in my own 1031 exchange, and 5 days into my 45 days, I put an industrial deal under contract. And the brokers were clients of mine, and so they found me this deal, and it was great. And so my best friend is a commercial construction lender. And he said, hey, Greg, you got to get a phase 1 environmental report on that property. And I said, I don't need to do that. The seller's going to carry back the financing, so I don't need to do that. He said, it's an industrial deal in an industrial area. You need to make sure that there's no environmental issues. You need to get a phase 1. So I said, okay, fine. So I paid $2,700, got a phase 1 environmental report. That took 30 days. So on day 35 of my own 1031, I get the phase 1 back. Guess what it says? It says you need to get a phase 2. A phase 2 is where they drill into the ground, take core samples, they go try to get to groundwater, and it costs $17,000. And I'm like, okay, I've got to get out of this deal. I only have 10 days left to identify property. Like, I'm going to be in trouble, right? And at that time, in that market, things were flying off the market, right? So I call these brokers that are clients of mine, and I say, listen, I'm going to have to get out of this deal. And they said, well, hold on a second. Let me talk to the seller. So I'm like, I don't know what that's going to do, but fine. So the seller says, listen, my grandfather built the property. We've owned it the entire time. I am so confident that there is no environmental issues that we'll pay the 17 grand. And I said, okay, if you're willing to pay the 17,000 bucks, I'll pay half when it comes back clean. So I stay in the deal. That phase 2 takes 45 days. So I am 80 days into my 1031. What do you think that phase 2 says? It is freaking terrible. They said there's like dry cleaning stuff in the ground. I mean, it's horrible. So one of my good buddies used to be a president of Little League. When I was president of Little League, was an environmental attorney. So I send him the report. And I'm like, hey, Mike, let me know. I mean, like, can I just get a discount on the property? What do I got to do here? He's like, you can't buy this. I'm like, no. I'll get a discount or something, right? He goes, no, there's not even a remediation plan. You cannot buy this property. So the sad thing is the exchange guy had his, like, I'm part of that 7% that failed because I couldn't complete my exchange because I had only identified that one property, right? So that's why when I tell people, get your due diligence done quickly, get your inspections done, get all of that done so you're not in that position, right? After the 45 days, you have 135 days to close. So the total exchange period is 180 days, right? The reinvestment rules are pretty straightforward. If I don't want to pay any money in taxes, I've got to do 2 basic things. I've got to buy something that's equal or greater in value to what I sold, and that's the net sales price of the property that you sold. So that's net of things like, title insurance, real escrow fees, real estate commissions, 1031 exchange fees. We charge $1,000. You can back all that out, right? So let's say I sell a property for $1.2 million. I pay, $100,000 in closing costs. It wouldn't be that much, but let's say I pay $100,000, use a round number. So my net sales price is $1.1 million. That's what I got to go replace. I got to go buy something that's $1.1 million or greater, and I have to reinvest all the proceeds from the sale. So equal or greater in value to the net sales price, reinvest all the proceeds. If I do those 2 things, I don't pay any taxes. But what if I want to buy a property that's less money? Can I do that? What do you guys think? Yes, you can do that. You can buy multiple properties too, right? You can buy a property that's less money. You just pay taxes on the difference, right? So I sell a property for $1.1 million. Let's say I find something I really like and it's $900,000. I can still do an exchange. I can still defer taxes, but I am going to pay taxes on that $200,000 difference. You can also combine properties, right? So I have a conference call on Monday where someone wants to sell 4 properties and then combine the proceeds to buy a larger property that can be professionally managed, right? The challenge with doing that type of transaction where you're combining properties is that your time clock starts the date that the first sale closes. So you got to kind of get all those properties listed for sale, at the same time. And as the first one goes under contract, you want to get the longest escrow period you can. And then as, the other ones go under contract, shorter and shorter and shorter. So I get agents that call me all the time, new agents that'll say, hey, Greg, I've got this client. They want to do a 1031 exchange. I'm super nervous. I've never done one before. What advice can you give me? And I'm always like, it's no big deal. It's just a sale and a purchase. Not, there's some time deadlines we have to comply with, but it's just a sale and a purchase. It's not that big a deal. And I said, tell me about your transaction. And she said, okay, well, he wants to sell 7 properties and exchange them into one. I'm like, you should be nervous. That's a lot of work, right? And so in that transaction, right, she got 5 of the sales closed before he has to close on the replacement property. And the other 2 that had not closed yet, we did a reverse exchange and reversed those properties in at a later date, right? Because it gave him another 180 days to get those other 2 properties sold, right? So there are ways you can combine them. Also, we have clients that, like I had a client 3 years ago that sold some vacant land here in the Valley to McDonald's and 1031 exchanged it into houses in Oklahoma. Does anybody know what a house in Oklahoma costs? Yeah, between $200,000 and $250,000. He sold his land for $2.5 million. I said, Gary, are you sure you want to buy that many houses? He said, yeah, I'm retired. I've got nothing to do. I'm like, well, you're going to get a lot to do here pretty soon. So he ended up buying 14 properties to complete his 1031. So he bought 14 single family residences that now, keep him busy basically full time. Managing, right? So you can do that. You could sell one property, buy multiple properties. We have clients that do that as well. So let's talk a little bit about partnership issues, right? So when you're doing a 1031 exchange, the tax person the payer that owns the property and sells the property has to be the same taxpayer that buys the new property. So I got an email yesterday from a client that said, hey, Greg, we own this property in Arizona in an LLC, and there's 2 members. And I'm like, okay. And they said, we want to go our separate ways. I said, okay. Well, the problem is you can't exchange an interest in a partnership. You guys don't own real estate. You own an interest in this LLC. In California, they don't like these things called drop-in swaps. So in California, right, in New York, they're like in a tax battle with each other. So, the easy way to structure that transaction in Arizona, it's fine, is we just dissolve the partnership, deed the property into tenants in common. So each person now is on title to the property. Then they sell the property and then each one can go their separate ways because they now own real estate, right? California doesn't like that transaction. So if Dana and I own a property together, right, in an LLC, and we go, hey, we want to sell and we'd like to go our separate ways. Dana goes, I want to go buy apartments. And I say, I want to go buy, net lease. So the problem is if we dissolve that partnership, deed it into tenants in common and immediately sell, the state of California's position on that, if we get audited, is that while the LLC held the property as an investment, Dana and Greg held the property primarily for sale, not for investment. And so therefore, Dana and Greg don't have a valid exchange. The reason that the IRS put something in the tax code which says a property that's held primarily for sale doesn't qualify under Section 1031 is because they don't want to see developers doing exchanges. Otherwise, developers would never pay taxes. They developed this office building, they'd refinance it once it was stabilized, pull cash out of it, and then sell it 1031 and go buy a new property. Just continue to do that for infinity, right? And so properties that are held primarily for sale don't qualify. Now, it's a bogus argument. The IRS has no interest in it, right? They're not pursuing it. But in California, It's one of the things that, the franchise tax board challenges exchanges on, is when you do those types of transactions. They're called drop-in swaps. Now, New York is seeing that California is challenging those transactions. So about 2 years ago, New York said, oh, you're not going to tax your residents more than us. We're going to start doing that too. So in California and New York are the two states where you essentially, if you wanted to sell an exchange and go your separate ways, I would say get out of the partnership, get into a tenant in common structure, a year or so before you want to sell. Then you can kind of sell and go your separate ways. Now, there are variations of that. There's a partnership division where you can divide the partnership into 2 sub-partnerships and then immediately sell. There are situations where you have one partner that wants to cash out and one partner that wants to exchange, where you keep the partner that wants to exchange in the LLC, add a member to it, and then you take the partner that wants to cash out and you make them a tenant in common alongside the LLC. Property sells, tenant in common investor gets cashed out, and then the LLCs move forward in exchange. There are multiple kind of ways to kind of get around that. But if you know that, hey, we want to sell this asset in the next 12 to 24 months, you're just better off putting in a position where, hey, we're tenants in common. You can form your own LLC if you want, and we're going to hold it that way for at least a year or 2 before we sell it. That's an easy way to kind of get around that, right? Now we see trusts coming up a lot. People inherit property in a trust, right? So you inherit a property in a trust, what happens? Heirs get a step up in basis, right? Basically eliminates the taxes. So 1031, also a good estate planning tool. We call it the swap till you drop approach. Exchange throughout your lifetime. When you pass away, heirs get a step up in basis. But the problem that we're seeing right now is that heirs are inheriting these properties in these trusts, and they're never transferring the property to their own name. They're just keeping it in the trust. And so you have clients that inherit a property 10 years ago, and the property's still in the trust. And so guess what? If I'm a beneficiary of the trust, it's just another partnership, right? And so now when the kids want to sell and go their separate ways, well, your step up was 10 years ago, so the property's appreciated, so there's gain there. And now I'm in a partnership, so I can't individually do my own exchange. I've got to do the same thing. I've got to dissolve I've got to, wind out the trust and make a distribution from the trust to each owner, and then probably hold it that way for a year before I do an exchange. So there is some tax planning, and if you guys, have questions about that, we certainly can get involved in that part of it early on. The key to exchange, like I said, advanced planning is kind of key. So did you have a question?
Kind of, yes. Earlier you mentioned something about, because I inherited a building.
Yep.
Through a trust with my grandmother.
Yep.
It's just unsold, and I have my siblings, and if I deem so, I give them some money. But I'm not so much looking into reinvesting. I'm just trying to get out without getting manhandled.
Yeah, so you can't do. I mean, you could.
Or if I
So when you
purchased the property with, like, I lived on property but rented out the other duplex or duplexes.
So the duplex could count, like the one that you rent out could count as part of a 1031, right? But the one that you lived in would be excluded. So like, let's say if you sold that asset, was doing a 1031 exchange, and you bought a duplex, let's say for $1 million, and it was, equal size, 500,000 of it would be your primary, and the other 500,000 would qualify for 1031.
You mentioned something about getting it out of, because it's been in the trust for, 8 years in August. So
Yeah.
I mean,
So is a trust issuing you guys K1s?
yes.
Yes.
I issued those to my
Yeah,
siblings.
so you've got to basically make a distribution from the trust to each of the beneficiaries, get them on title as tenants in common, and then report it, I would say, for at least a year under your own tax ID number under Schedule E. And then once you've done that, I think you probably sell the asset and guys can go your separate ways. Yeah. Yeah.
So my question is, if I have a primary residence
Yep.
and I convert it to rental for 2 years,
Yep.
can I do the 1031 exchange?
Yep.
Versus selling the property outright and buying another primary residence within 2 years to get the property to save
Prop 19, right?
Prop
Yep.
19.
Yep.
Is there a tool where I can plug in assumptions and try and decide which one is better for me?
Well, the first thing I would do is just call your CPA and say, okay, if I sell this property for X, right?
I do my own tax basis. I used to be a CPA.
So, well, good. So then you could figure out what you're going to pay in capital gains taxes. And then you're going to look at, okay, if I sell this property and I, take my 500,000 or 250 plus whatever improvements that I made, what does that gain look like? And then if I, just take it and, turn it into an investment, I can defer those taxes, but my new property taxes on whatever I buy, I'm now paying $5,000 a month. They're going to be $15,000 a month. And then you look at the long-term side of that to figure out what that investment's going to be. Like, what's the difference?
I was hoping for a tool where I could throw in assumptions like how long I'm going to be in the next property. Put a savings on
No one makes a tool that's that specific, right? Because I do think that it's an interesting thing. And I do think it's a conversation I've had with a lot of people, right? Where they're like, hey, my primary residence appreciated way over what I can take exclusion with, right? I've got, the question becomes, do I, convert it to investment property and then, go buy another investment property and then not worry about the property taxes? Or do I sell it, pay the capital gains taxes, and then use Prop 19 to move it into a next property?
It just changes your assumptions. If your assumptions change, then the answer changes.
There's lots of variables. The first thing is, the question becomes like, can you do that? So I have clients that are going to sell their primary, but need to use those funds to go buy another primary. And I'm like, just sell and pay the taxes. Because if you want to use that next property as primary, first thing you have to do is rent that property out for probably 2 years. Yeah. And then you've got to sell it, do a 1031, go buy a new property, rent that property out for 2 years so that's a 4-year gap before you could convert it back to a primary. So you're going to have to go rent something for essentially 4 years. Do you want to live in a rental for 4 years? Like I have a client right now that sold a hotel for like $7 million. He's like 82 years old. I was talking to him like 2 weeks ago, and he's like, well, maybe I'll just use part of the proceeds and buy a property that I'm going to live in, and I'll just rent something out for 2 years. I'm like, you're 82. Do you really want to rent something out for 2 years? But he's so opposed to paying taxes. He's like, yeah, I don't care. I'll just live in this rental. I'm like, oh boy. So to be fair, he's ran this hotel for like 50 years. So, so he's just really, pretty tough. But yeah, I would say that the problem with that is there's always so many different assumptions. But
like I have a friend that has a $3 million
right.
equity. I'm not in that place.
Yeah.
He had to do a 1031.
Right. Yeah.
The capital gains.
Yeah. You're seeing more and more people right now that have gains significantly over that threshold where it gets to a point where, now I also am seeing people that, and I'm certainly not suggesting this, are those cameras off? Can we turn those? No, I'm kidding. I'm doing an exchange for a client right now where I swear the property he's selling and the property he's buying is going to be a primary. When you see people selling properties that are north of 10 million and they're buying single families north of 10 million, I'm like, there's no way that's investment property. Now, I am not the IRS. He's telling me it's investment property, so that's fine. But people are like, oh yeah, I rent it to my corporation and they pay, rent. I'm like, okay, my opinion is this: being tax aggressive is okay, right? So I, on that deal that I sold in La Quinta, right, and my own exchange that failed and I ended up paying taxes anyway, but I only owned that property for 9 months. When I bought that property in La Quinta, I bought it as a short-term rental. And at the time that I bought it, there was a temporary moratorium for short-term rental permits because of COVID. And I was like, okay, at some point this COVID thing's gonna go away and I'll be able to get a short-term rental permit. So for 8 months, my wife remodeled the house. And then about 6 months in, the city of La Quinta put a permanent moratorium in place for short-term rental permits. So I could no longer use it as a short-term rental. And so it no longer made as much sense. Now, on the face of it, you would say, oh, well, he just flipped it. He bought it, he rehabbed it, he flipped it, right? But I really bought it with the intention of holding it for investment. And if I was ever challenged in an audit, that would kind of be the position that I took, right? So I think that there are lots of kind of gray areas within 1031. But, knowingly trying to defraud the government by renting the property to a corporation that you own and then you live there, that's tax fraud. That's not, yeah.
can you deduct upgrade an investment in the unit that you'd like to exchange? Can you
Yeah,
charge
so there's just an exchange called an improvement exchange where you sell a property, you 1031 into a new property. Let's say you have leftover funds and you use those funds to make improvements. Now, the problem with improvement exchanges is it's okay if you're improving an existing property because you only have 180 days. So where you run into challenges when people want to do ground up construction, you just can't usually get that done in time. Although I am doing one in Texas where it's a little town in Texas. They must just write on a napkin, show it to the guy planning. He's like, yeah, that looks good. And they just start building.
But I'm asking, you have your own home, whatever, you rent it,
Yeah.
and you put a lot of investment to upgrade it.
Yep.
Now you do exchange.
Yep.
Can you deduct the investment that you put into
It
this right
depends. Yeah. So any cash you take from the sale of an investment property is considered boot and taxable. But any improvements that you make that are considered repairs, right, and not improvements, you can write off typically in a single tax year. So if you say, oh, I spent $50,000 improving this property before I sold it, if you take $50,000, right, from the sale, that money will be taxable. But you'll have a $50,000 write-off that you can offset it on your tax return. You want to make sure that you talk to your CPA and make sure that the write-offs are considered repairs and not improvements, because improvements have to be depreciated versus a repair, which can be written off in a single year. Yeah.
Great. Do you charge fixed fees or?
Yeah, we charge a flat fee. It's $1,000, and that handles one sale, one purchase. And then if you bought more than one property, it's $500. So it's $500 per kind of basically transactions. Yeah. Yeah. Yeah.
You recommended to, I don't know if you recommended, but mention something about if it's in a trust, like when you're waiting for it to transfer, would that go to an LLC?
So you could create individual LLCs. So on commercial real estate, I do think a good way to own, or investment real estate, a good way to own property is in an LLC. I think the best way to own property is in an LLC that's wholly owned by your trust, right? So you have your LLC that holds the real estate, and that LLC limits the liability to that asset, right? Or only assets that it owns. And then if you have your trust underneath that, right, then you have the estate ability of the trust. So if I pass away, right, my trust is there, right? If someone slips and falls and tries to sue me, the LLC is there to protect me personally, right? So I think that's the best way to own real estate. So you could set it up if you go, hey, we need to dissolve this trust, put our property in our own names, and you go, listen, I don't want to take title to this property in my own name. I want to form my own individual LLC. So you could form your own individual LLC, which would own your portion of the property. Yeah. Yeah.
The 2-year requirement,
Yes.
does it have to be leased up for the full 2 years? What if you're like having a problem for 6 months it's vacant?
So let's talk about that. So, because I talked about vacation homes and how they qualify. So the rule for a property to qualify, so if you look at the basic definition of a 1031, right, it doesn't say a property has to produce income in order to qualify for an exchange, right? Because what if you own vacant land? It doesn't have to produce income. And so there's no requirement that a property produces income. But the one thing you want to make sure of is that you're not living there or using it, considerably, and that you show at least 2 weeks of income a year. So like as VRBOs, or Airbnbs, those qualify as investment properties. So I had a client here, sold an apartment building for $4.8 million. They took $800,000 of that and used it to go buy a condo in Hawaii. And so the woman called me, her name was Betty. She called me up about 4 months after they completed their exchange. She said, hey, Greg, I've got 90 days of rentals on the books for that condo that we bought in Hawaii. I said, oh, that's great. She said, I'm wondering though, is there any way that we can spend more than 14 days a year there? Because I know the rules for a vacation home in order to qualify as an investment says I can't use it for more than 14 days for personal use. And I said, well, if you look into that code, it does say that any time that you spend there doing maintenance or making improvements does not count against your 2 weeks. So for the first 2 years, She did a lot of maintenance, made a lot of improvements. And then after 2 years, she kind of did whatever she wanted, right? So there are kind of ways to get around that within reason, right? So yeah, I would say that if you can't rent it for 6 months, it's not the end of the world, right? It doesn't have to be a full-time rental where it produces income all the time. So let's talk a little bit about reverse exchanges. So like a reverse exchange is we're buying the property that we want before we sell the property that we have. They have become more and more popular, but the challenge of that is, right, is that I'm buying what I want before I sell what I have. So guess what I don't have? I don't have the money from that sale yet, right? So I've got to have some capital available to be able to complete that. On residential transactions, it's very hard to get a loan. And the reason is because in a reverse exchange, the qualified intermediary accommodator, this exchange company, creates an LLC that becomes the title holder of the property that you're buying. So let's say, Dana and Charlie have a listing for 4 units that you saw that you really liked. And so you made an offer on it and you called her up and you said, hey, Dana, I really want to make an offer on this property, but I have this other property in Encino. I'd really like to sell and exchange into that. She said, listen, I totally get it, but the problem is I'm getting kind of multiple offers. And so I don't think the seller is going to wait for you to get your property sold. And you say, well, I have some capital available that I could buy it with. So you go ahead and make the offer. You make an offer, you put it under contract, just like you would any other deal, right? You hire us. We step in and create an LLC that we're the sole member of. We make the client the manager of it, and it becomes the new buyer. So it assigns in the transaction as the new buyer. The client loans the money to the LLC to buy the property. We then give them back a note for that loan. We then acquire the property and then triple net lease it back to the customer. So they collect rents, they pay property taxes, they do insurance on it. We're just holding title, right? And from the date we close, it's a flip-flop of a regular 1031. So you then have 45 days to identify the property or properties you'd like to sell, and you have up to 6 months to get them sold. Once the property that you're selling goes under contract and into escrow, we assign into that transaction like a regular 1031. So when that sale closes, the proceeds of the sale come to us, and then we use that money to pay you back the money you loaned the LLC to buy this property. And then once we've completed that, we then give you 100% interest in the LLC. So this LLC that's holding title, you become the 100% owner of it. And the reason we structure it that way is to avoid double transfer taxes. So in if we did a transfer to you, right, you'd have property transferring to us transferring it to you, double transfer taxes. But we then give you 100% interest in the LLC. So you end up owning the property in the LLC we created. Now, reverse exchanges, more complex, also more expensive, right? Reverse exchanges probably for most deals are somewhere between $7,500 to $10,000. So it's a more expensive type of an exchange, but you're not stuck in that 45 days. And if you see something you really want, you can go out and get it right now, right? You don't have to wait to get your property sold. So it is a viable option. They do take more time to set up. Usually they take about 2 weeks to set up, where a regular exchange, we can do it in a couple days. But they're more complex from our standpoint. From your standpoint, they're just more expensive, right? But they are an option for you guys. Now, do you have any questions?
Can you talk a little bit more about the boot again?
Yeah, so boot is anything that you receive other than like-kind property, right? So if I sell a property for $1.1 million, let's say net, let's say I have $500,000 in cash, right? I've got to go buy something for $1.1 million, and I've got to reinvest that $500,000. Now, if I take any cash from the sale, that's considered boot and is taxable. Or if I buy a less expensive property, and still invest the $500,000, that's considered mortgage boot, and I get taxed on that, right? So I've got to buy something equal or greater than that $1.1 million. I also have to reinvest the $500,000. If I don't do that, then either one of those things are considered prudent. Now I can buy a more expensive property, right? And I can add money to the sale, right? So it's just something that comes up a lot. People are like, oh, you've got to get equal or greater debt. You don't have to get equal or greater debt. You can offset debt with cash. So if I want to come in with more money, no problem, right? I had a client, it was a while back. They were, in Greece. They had owned a property in Hollywood. They had owned it for a very long time. It had no debt on it. It was worth about $5 million. And their son was selling it for them. They were in like Mykonos, Greece, partying. And they said, hey, Greg, we want to sell this property and we're going to take $2 million from the sale as cash. And we're going to 1031 exchange the other $3 million. And they had paid like $1 million for it, right? So there was still going to be a tax benefit, to doing this $3 million exchange. I said, well, here's the deal. You can do that. It's your money, right? They go, we know, we're going to pay taxes on it, but we want the money. We're retired now and we're partying in Greece and Spain. And we want, our whole life, we never took anything from this property. We always put money into it. And now we're retired. We want to have a good time. And I said, you can do that, right? Absolutely can do that, right? But understand that $2 million is probably going to look like $1,350,000, or $1,300,000 by the time you get done paying taxes on it. I said, so why don't you just keep that money in the deal? They're like, we want cash. I said, I totally get it, right? Sell the deal for $5 million. 1031 exchange it, go buy a new deal for $5 million, right? They ended up buying a couple net lease investments. So I said, then refinance that asset. Pull out, let's say, $1.5 million. And then you're still going to cash flow, right? Property's still going to make money for you every month. And you actually have $1.5 million. You don't have $1.350,000, and you have $500,000 more equity in that property that's making you money. Like, it's a better plan, right? So they ended up being reasonable and listening to me, and ended up doing that. But so when it's a big number like that, you're almost, especially if you don't have a lot of debt, you're almost just better off keeping that money in the deal, exchanging it, taking cash out, and then just, allowing the property to kind of go that route. So any other questions? Yeah.
So we're trying to, a parent's house, 1031 exchange.
Yep.
We ended up having to do a total rehab.
Yep.
So we spent, let's say, about $300,000
Yep.
on fixing it up.
Okay.
Are we able to take that, have the proceeds pay us back? No.
So any money that you take from the sale, right? Yeah. So the question is, hey, I own this property. We spent $300,000 on it, and we're now going to sell it. And anytime I hear a phone ring, I always remember this funny story. So I was speaking at a huge apartment conference one time, and there was like 500 people in this room. And so this guy's phone in the front row will not stop ringing. So like an idiot, I'm up at this podium, right, speaking, and I go, hey, can we just kind of turn our phones off? And right as I got done saying that, my phone in my pocket rang. So I never say anything about that. Yeah. Used to be like everybody had like these ringtones that were like music or something. And I was like, that like doesn't, like what I'm seeing in that music like doesn't match up, right? Yeah. So so the question becomes, can I take that money back, right? I just put $300,000 of my own money into this deal. I don't necessarily want to keep it in there and have to 1031 it, which is a very common question, right? And so the question becomes, are they improvements or are they repairs? Improvements have to be depreciated, right, over a period of time. Repairs can be taken in a single year, right? So let's say if you can allocate, $150,000 of that was repairs. We did plumbing repairs and we repaired a foundation issue or whatever. All of that money, I think you can take, right? So you take, let's say it's $150,000. You could take the $150,000 from the sale, and then you could write off $150,000 on your return to offset it. So it'd be like a net zero, right? So you have a $150,000 gain, $150,000 loss, write it off against each other. And so ultimately you keep the 150 grand. So that's something that you should work with your CPA on, but classifying which ones are repairs versus which ones are improvements. Yeah. And I see we've got some Dodger people in here. That I thought my eyes were deceiving me with the upside down Dodger hat there. I was like, is my blood pressure super high? This was a good win yesterday. My brother-in-law, diehard Yankee fan, so I was happy to see that. And I was at my daughter's swim, deal. So he was like, "You watching the game?" I'm like, "I'm hoping that it recorded on my DVR," which it did not. And so then I caught up with the highlights, and I'm like, "Yeah, what a game last night, right?" So we'll see how it goes. We'll see how the next game goes. So, any questions?
Did you review the Prop 19?
So Prop 19 essentially allows people that are 55 or over to transfer their property taxes into another primary residence, right? It also, if somebody inherits a property, requires that person that inherits the property, in order to keep that property taxes, it has to be their primary residence, right? So like my son inherited a property from his grandfather, and for order to keep that basis, the tax basis in the property, which is like $1,400 a year, he has to show that as his primary residence, that's where he lives. So you can also buy up in value, right? So you can buy, a more expensive property than the one you sold and still transfer your property tax. You just pay taxes on the difference, right? So if I sell my asset, let's say for 1.5 million, I ended up, and let's say my property taxes are based off of 500,000, I could go buy a more expensive property than that. I can transfer my $500,000 basis over, but the difference, I'm going to pay property taxes on that difference at a current rate, right? So let's say I'm paying $7,000 a year, right? And I buy a property that's $200,000 more. I'm going to pay current property taxes on that $200,000 plus the money that I was already paying. So, it is a huge advantage of, allowing it. And I think it's a good thing. I don't think Prop 13 is going to go away. In some states, the property taxes are crazy, right? So I have a client that owns in Texas, and they redo property taxes almost every year, and they jack it up like over what it's worth sometimes. And then you have to hire somebody to go to the assessor to try to get the property down. So it's an interesting deal in some other states.
So does the state figure out, the franchise tax board figure out that formula with the Prop 19 transfer, or is that something a CPA does?
There's a form I think that you file showing that you still have that, right? So you're saying, hey, I sold this asset, this is what my property tax was, and you file it with the county assessor.
So the CPA would know.
Yeah.
Those
Usually
forms.
during escrow, right, Charlie? Usually the escrow officer and your realtor will help you with that. Make sure it's filed properly.
Yeah. Yeah, it's something you file with the county assessor, not with the FTB, because that's where the bill's coming from. Yeah.
Is the price they base that on the sale price or after the capital gains are paid on it? Which price, like, for instance, you sell a house for $2 million.
Yep.
And the capital gains are 500,000.
Yeah.
Are they gonna go $1.5 million that you have to spend more, or is it based on the
$2 million less closing costs. So you take the $2 million sales price back out. Let's say you pay 5% in closing costs. That's $100,000. You got to go buy something for $1.9 million or greater to complete your exchange. Yeah. Unfortunately, you're not able to just reinvest your gain. Yeah.
If you buy the $2 million place and sell a $2 million place, you're gonna be paying the higher taxes on that extra 100,000.
Well, are you talking about Prop 19 or 10?
19,
Yeah, no.
Move the tax rate.
No. It's based off of what the current selling price is. So if you sell a property for $2 million and you're paying property tax at $500,000 and you buy a new property for $2 million, you'll still pay property taxes at $500,000. Yeah.
Is it, the exchange good for all counties in California or only Southern California?
Prop 19 is for all of California. 1031 is for all of the U.S.
So it's all California now, 'cause it used to only be.
It used to be county specific, right? Yeah.
Now it's federal.
Yeah. Yeah, and there were some counties that reciprocated, with LA County, but now it's statewide. Yeah, yeah. So you guys are free to move about the state. Yeah, go ahead.
Can you talk a little bit more about the Delaware statutory trust?
Yeah, so basically like the DSTs used to be called TICs before. They changed it into what they call Delaware Statutory Trust to give the sponsor kind of more control of the real estate. And the reason was because as a TIC, everybody had to agree to do anything, right? And so in some of these properties, you would have 40 or 50 investors. And so could you imagine getting 40 or 50 people to saying like, hey, we need to refinance. And all 50 people have to say, yeah, we agree with that. You get 1 or 2 dissenting votes, and then you've got major problems. So now they've structured where a DST, where the sponsor kind of has more ability to do it. And the DSTs, you know, they're sponsors that specialize in different assets, like Inland just bought the apartment building right across, that's brand new one right across from USC. It's a student housing, so Inland's really big on student housing right now. There are companies that specialize in self-storage, like I got a client that just exchanged into 16 self-storage facilities in Texas. There are companies that specialize in triple net leases, like that company in Pasadena Exchange Right, where they buy a portfolio of triple net leases and they sell those off. And so the thing about the DSTs is, like I said, you're no longer kind of in control of your real estate. Like you get on the bus is headed to Florida, you can't say, I want out. There's really not a secondary market for those things. So they typically have a life cycle of 5 to 7 years. So you kind of buy into those deals, and every 5 to 7 years or so, they sell the asset off. And then you have that event and you can decide, okay, I want to go back into a DST, or I want to go buy my own real estate, or I want to cash out and pay my taxes. Another thing that you're seeing with these DST companies right now is they're rolling into a REIT. So a thing that's kind of popular right now, Ares has one, Jones Lang LaSalle has one, Cantor Fitzgerald has one, where you buy into a DST. Actually, Blue Owl is another company that has one. So you have this big REIT, this real estate investment trust, and they own $10 billion of real estate. So they have this huge real estate portfolio, this REIT that's running the property that's then, owned by shareholders, right? And so they're saying, okay, we're going to take a couple properties out of the REIT and sell them as a DST. So they sell them off to 1031 exchange buyers. And then they exchange into this DST investment, right? Could be 2 apartment buildings, right? Then they hold that asset like that for 2 years to kind of meet the held for requirements of 1031. Then they roll that back into the REIT. And instead of owning an interest in those 2 properties, you now have partnership operating units in the REIT. So now you own partnership operating units in this REIT that owns 250 properties. Once you do that, though, you cannot get out without taxable event, right? Well, if you die, you can get a step up in basis. But if you ever want to convert your shares and, into cash, you do this thing called an UPREIT, where you exchange your partnership operating units into stock. And once you do that, those stock shares become taxable. And then you could sell off the stock, raise some capital. But the interesting thing about that is, and I have some clients that do a little bit of both of that, is they'll exchange maybe some into DSTs, and they'll exchange some into DSTs that are going to roll into a REIT. Once you've held the REIT for a year, you can then kind of create liquidity events, but you don't have to sell it all, right? So if I own $400,000 in REIT shares, and I decide, you know what, I want to cash out 50 grand. You can do that. You can just cash out $50,000. The thing that I don't like about it is it kind of takes you out of the real estate game. You no longer have the ability to exchange out of those assets. But it is an option. And we are seeing a lot of people kind of do that, go into those. My suggestion would be, if you're looking at a DST, always look at the real estate. Anytime, I would say more than once a week, I get a phone call from somebody that says, we're thinking about doing a DST. Is there some good companies that you can recommend? And there are some good companies out there. But the problem with a lot of this product type, in my opinion, is these are sold not as real estate for the most part. There is a company called Kings Barn that does sell them as real estate. But almost all of the other companies sell them as a Reg D offering. So they're sold through financial advisors. 99% of financial advisors know nothing about real estate. So you have this financial advisor going, here's these 3 properties. This one pays 4.5%, this one pays 5%, this one pays 5.5%. What do you want to do? And you're like, what do you mean what do I want to do? Well, like they're all good. Well, like they don't know anything about it, right? They don't have a background in real estate. They're like people that sell mutual funds and life insurance policies and stock, right? And so that is the biggest challenge about about these DSTs is they're not real estate people selling real estate, which scares the daylights out of me, right? And they're always saying, oh, well, like we have this 360-page private placement memorandum that we have to come out with saying all the potential risks that are associated with owning this property. You think those advisors are looking at that frickin' PPM? They're not looking at it, right? Dana, Charlie, they know how to underwrite real estate risk. Like she had a deal for sale, to be fair, and I was like, oh, what do you think about this deal? She's like, I don't think it's very good. I was like, what? She's like, yeah, it'll sell to somebody that knows how to operate in that market, but it's a challenging market to operate in, right? And so that's the thing that scares me a little bit about the DSTs. The other thing that scares me a little bit is that they're not doing it out of the goodness of their heart. They're buying these deals for, let's say, $80 million. And then they're marking it up to $85 million and selling it back to the investors, right? And to be fair, right, people are in the business of making money. That's, understandable. But you're buying it already kind of at a premium because the due diligence has been done, the financing is in place. But it is, I have had a lot of clients that go into it. I probably have 50 people a month that go into the DST market because they just want to be passive owners. They can get diversification. They can buy deals from different companies, different asset classes, different parts of the country. Now, I did have a client I spoke to last week who about 3 years ago sold an investment and went into 26 different DSTs because the minimums on those is a lot of times $250,000 in equity. So they sold a fairly decent sized deal. What he didn't realize is that every state he owned a DST in, guess what he had to do? He had to file a tax return. So now he has like 16 different tax returns in 16 different states he had to file. So that's something to kind of also to take into consideration a little bit. But it is an interesting option, which does, like I said, allow for some diversification, obviously reduces your management responsibilities. You just want to look always at the real estate that you're buying, right? Make sure that you're going and buying good real estate. And that's advice I give really all of the people that are doing exchanges. When clients are in an exchange and they're looking for property, and I'll tell you guys kind of a little secret about our business. I get a call at least once a week, probably twice a week, from an agent that says, hey, Greg, I've got this deal that would be great for a 1031 exchange buyer. What do you think that's code word for? We are overpriced. We can't sell it on the open market. We're hoping someone's in an exchange in desperation that will just jump into this deal. That doesn't typically happen. Does an exchange buyer or will an exchange buyer pay maybe a little bit more? If Dana or Charlie has a listing and I'm in an exchange and maybe it's competitive, right? And I got to pay a little bit more than it's listed for, or that maybe I would like to pay for it, 5% or whatever, and I'm looking at paying 30% in taxes, I don't have a problem with that, right? I don't have a problem with that because I'm still saving money, right? And I'm getting an asset that I want. But what I tell all of my customers are, do not buy an asset simply to save money in taxes. That is a recipe for disaster. It's like the old saying, don't take good money and throw it after bad, right? You made money, right, on your deal, right? If you can't find something that you really want, that you really think is a good investment, pay the taxes. Don't go buy something just to go buy it so you're not paying taxes, right? And that's where the advanced planning comes in, and hopefully you won't be in that position. But don't be in a position where you're like, you know what, I'm just going to buy it because I don't want to pay taxes, right? I literally had that conversation with somebody yesterday. He's like, I can't pay $350,000 in taxes. I'm like, it's better than buying a bad deal. It really is. Yeah.
So you can go into 1031, and if you don't find it, then you just pay the taxes.
Yeah, I would say a good part of that 7% of exchanges that fail, and I think it's something that we put on the flyer, so I'll talk about that too, are people that go into exchanges that aren't necessarily convinced that they want to go buy something. I just opened one for a client like 2 weeks ago. He's like, I'm not 100% I want to buy something, but for $1,000, he was closing like at the end of the week. I'm just going to open an exchange, look for 45 days, make sure that there's nothing out there that I want to buy. And if I don't find something I absolutely love, I'm just going to pay the taxes. At the end of the year, after October 16th, we do have clients that open exchanges that have no intention of completing them. They're using this thing called tax straddling, where they're saying, hey, you know what? I'm going to go ahead and open an exchange. Let's say so the rules for 1031 say you have 180 days to complete your exchange or the date your tax return is due. Well, tax return is due typically April 15th. So October 16th to April 15th is 180 days. Once you get past that, right, you have clients that are opening exchanges at the end of the year with no intention of completing them. And the reason that they're doing that is to do this thing called tax straddling. So essentially what they're doing is they're sending the money over to the exchange company, and on their, let's say, 25 return, they're going to report that money as an installment sale under Section 453, saying, I didn't receive the funds, right? And then on their 26 return, when they file that in April of 2027, that's they're going to report with the income, because they're not going to get the funds back, right, until when? Until 2026, right? So they can essentially hold off on paying taxes, for another year and a half almost, right?
Maybe their income will be less that
Right.
year.
That's right. Yeah. Yeah. So there are tax planning ways around. Now, you're not getting out of paying the taxes. You're just delaying it, kicking it down the road. Yeah.
In that identification period, I get hung up on this. So let's just say, for example, I say, okay, here's 3 properties,
Yep.
and I've got 180 days, right? Can I actually end up buying a 4th property that I didn't quote identify?
You cannot. So
It has to be what I said.
yeah.
Oh,
Yeah. So once you identify a property, you're past your 45 days, you can only buy something on that list.
And you're limited to 3 IDs.
So there are 2 basic rules that people use. There's actually 3 rules, but there's 2 rules that people use. They use the 3 property rule, which just limits them to 3. Most people sell 1 property and buy 1 property, right? So they typically identify under the 3 property rule. But remember, I talked about that client that sold vacant land here and bought houses in Oklahoma. He certainly couldn't use the 3 property rule, right? So he used a rule called the 200% rule. And that rule is typically for someone that wants to diversify, right? And under that rule, it says identify as many properties as you want, but the total aggregate value of what you identify has to be less than twice the value of the property that you sold. So he sold $2.5 million sale of that land. He could identify up to $5 million worth of real estate, right? Twice the value of the property. So he ended up identifying 27 properties and ended up buying 13 or 14 of that 27 to complete his exchange. So those are the 2 basic rules you use. Selling 1, buying 1, probably the 3 property rule. Selling 1, buying multiple properties, probably the 200%.
I'll share one thing. Normally, the form that you use to identify comes from, the accommodator company. So you're generally already in escrow. You've done your inspections once you put one of those properties on the list. You don't have to identify it just because you're making an offer or just because you're in escrow. You want to wait to identify anything until you're sure it's a really solid deal.
What is the rationalization to start with? Is it just to make sure everyone's serious about doing it?
So I'll tell you how the 45 days. So yeah, so one of my buddies, his name's Adam Handler. He worked for the Treasury Department back in the 80s when they came up with Section 1031. Now 1031s have been around for 100 years, but there was no actual tax law on it. So They had finished basically writing it. He went into his boss, and his boss said, can't we put something about them having to tell us what properties that they are going to buy? And so literally at the last minute, they came up with this crazy 45-day rule. Now, right now, there's an extension for all LA County residents because of the fire. So if you're in an exchange right now, right, let's say you close today, your 45th day is not till October 15th because it extends all time-sensitive tax deadlines to October 15th. Even if you're not affected. So if you're just an LA County resident or your primary place of business is in LA County, you're considered an affected taxpayer. You can extend those time deadlines. So it's obviously a very advantageous time to sell. Now, when we have these kind of disasters that occur, right? More exchanges fail because people don't aggressively pursue properties. So I'll give you kind of an example. So there's an exchange called a 1033. So a 1033 exchange is when a government agency essentially comes in and buys your property through eminent domain. It also is, there's a fire-related issue there on people that lost their houses in the fire, but we'll just talk about that. So in a 1033 exchange, you don't need to use an exchange company, right? And you have 2 years to reinvest. How many of those exchanges do you think are successful? 30%. 70% of them fail for 2 reasons. What do you think is the number one? So you don't need to use an exchange company, so clients can hold on to their own money. What do you think they do? They spend it. That's the number one reason. The second reason is they just forget about it. If you sold your property today and I said, hey, you have 2 years to reinvest, you'd be like, yeah, let's just wait a little while. I'm not going to look for anything right now. I'll wait a year, see what happens, right? So you wait, don't complete it, right? So while the 45 days is a challenge, and look, I blew up my own exchange 2 years ago because of it. It is beneficial because it forces you to kind of get there. Yeah, get out there and aggressively pursue properties. Yeah. All right. You don't have to, but you should. Yeah, you should. Yeah, you should have it in escrow. Try to get your due diligence done. A lot of the deals that we do, before when the sale closes, they're already under contract on their purchase. And they're under contract in escrow and they've got a lot of due diligence done. And so on average, we hold on to people's money for 41 days. So that tells you that most people are aggressively pursuing properties, getting things under contract, getting due diligence done. So when the money comes, I always tell clients, the perfect exchange, money comes to us and then a couple days later, a week later, we send it to your purchase. Because when it's sitting with us, yeah, you're earning some interest from the bank, but you're really not making money, right? So you want that money back into the real estate market where it's continuing to make money. So the faster you can get that done, usually the better off you are.
It sounds like a couple people might have some, questions about the logistics behind. Generally, what we recommend is we figure out what your property is worth or properties that you're thinking about selling. And so we can do a market analysis, whether it's a residential, multifamily, or commercial. We can work with you on that, give you a presentation. These are the comps. This is an income and expense analysis. This is what the market is like for selling that kind of property. This is how long we can expect it to take to get offers. Who's the most likely buyer for something like this, all that kind of stuff. Then we talk about what you might want to buy and how much is that and where is that and what kind of properties would be in your price range, and do you want to get a new loan, and do you have money to add to the deal, all that kind of thing. And so those are sort of the preliminary conversations we have. Before we even recommend you listing your property, we want to have a picture for you, a vision of what that ideal exchange is. And what does this look for you guys long term? We want to look at, okay, well, I want to sell this house and buy a 10 unit. Okay, well, what's for sale right now? Let's make sure that those cash flow and that you understand everything, related to owning that type of property. And so once you sort of have that picture in mind, then we can get into the process of preparing the property for sale. Do we need to do any improvements? Do we need to pull, make sure we have all your paperwork in line, like leases or, whatever it is regarding the property. And then we get to the aspect of putting it on the market, doing the marketing, the marketing and getting it into escrow. That's one aspect of the sale. And then once we sort of get it into escrow, we do inspections, then it's like, okay, now we really need to make sure that we're starting to make those offers and look at what you're going to be purchasing. So then that's another aspect that you sort of transition into. Yeah.
Question. See, that's my issue because it's an apartment complex. My grandma left me. It's in Boyle Heights, so everything remotely close to my grandma's property. The purchaser buys it, knocks it down, and then puts whatever they want up. And my thing is, I made the mistake, I don't know, like 3 months ago to replying to a text like, how much is your property worth?
Oh.
And I made the mistake of giving my info, so I just get these calls nonstop. And my thing is, they want to know rent roll, they want to know costs, and it's like, I'm a Roybal. It's that one property, the apartment complex that my grandma left me. I'm the beneficiary of the trust, and my decisions are whatever they are. And that's my thing is where I get caught up. It's like, I know what you're gonna do with the property. You want the location, you want the lot, because it's like on a block and a half. You don't want to put more money into this building, knock it down. And that's my issue where it's like, okay, so.
Meaning you don't want to see someone tear it down, or
No, they're gonna tear it down. It's just
how many units is it?
8.
They might not tear it down, depending on.
I mean, again, based on my surrounding from, again, I'm at Boyle Heights, so right there by General Hospital, 3 blocks this way. It's a similar building as apartment as my grandmother's. Now they got.
But was a
20
house there
units up.
before?
I'm sorry?
Was there a house on the lot before?
No, man, it's just.
No, on the other properties where, because there's
No, it was an apartment complex similar to my grandmother's, 6
that
to
they
10
tore it
units.
down.
Yeah.
Oh,
So every
maybe.
apartment similar to my grandmother's, as you drive through,
Yeah.
you can talk like you see them put up these more modern, if you will.
Yeah, well, a lot of the homes that are on a decent sized lot, those you're getting torn down to build the new construction 4 units over there, and then they'll do like 4 units plus a couple ADUs,
Sure.
and it's a couple stories high. Those are very common because it's a lot easier to tear down a house than it is to remove rental units from the rental market. When you tear down apartment buildings and things that are rented, the financials of that are very different. But that's something that we can look into and say, okay, well, this is what it's worth as an apartment building as is, and would it be worth more as a development deal? Like I said, determining who's the best buyer. So we could definitely work with you on that. Go ahead.
What are your fees for all this advice that you give, what to do with your rental units or?
That's a good question. The only fees are the commission and the sale. Yeah.
She's free for a long time before she gets paid. Yeah.
It's a lot of
Yeah.
a lot of legwork that pays off at one point.
Yeah.
Maybe, well, twice if we do the exchange.
Yeah.
If you have rental units in Arizona that you were thinking of 1031ing into something in California, does realtor in Arizona sell those 3 houses?
Yes.
And then you deal with the other half.
Yes, and I can, if you'd like, I can help you find somebody, in Arizona, whatever city you're in, who has experience selling that particular type of property, and I can, vet them for you, ask them the right questions, make sure that they have experience selling exactly what you own, they're active in the market, and know how to handle this type of thing, and then Greg can still do your exchange, and then I can work with you with where we can whatever you want to purchase here. But our licenses are only good for California. But we have a really big network of agents, and I've definitely done that before where I've vetted other agents for clients who are either purchasing or selling in other areas, other states?
Yeah, I would say at the very least, it's good to have a conversation with Dana and Charlie and say, hey, you know what? I own this asset. I'm considering selling it. And this is kind of what my goal is. And then see if it's really an accomplishable goal, right? If I'm like, hey, I own these 3 units in Arizona and I want to move them to California and I want to buy units here, what does that look like? And they can give you a pretty good realistic look on what that looks like.
Yeah. And if you're selling something here, whether it's apartments or residential, Charlie is really great at sort of like envisioning how to prep the property for sale. And that's like one of his favorite things is working, especially with either like single family owners or smaller properties, where it makes sense to put a lot of some work up front into the residents, because right now, I mean, everyone really just like buys real estate on their phones. And so you have one chance to have one photo that is really going to like attract people, get them to want to come see your property. And that's one thing that we've been pretty good in achieving.
Yeah, it's interesting. I mean, I really never thought about that, but like, my wife's like, oh, maybe we'll go retire in Scottsdale. And it's true though. You look on like realtor.com and you're like, I'm not even looking at that. You just keep on scrolling. So it is kind of interesting that you have that first picture, right? Really gives you an opportunity for people to look in further into your property.
Yeah.
Especially if the property has a lot of deferred maintenance.
Yeah.
Because most people want to get that fixer pricing.
Yeah.
So if we can get that stigma off the property,
Right.
it increases the property at least, sometimes 15, 20, 30%.
Yeah.
One last question.
Yeah.
Okay, so you said if I sold the building for X, I need to invest at the minimum X, or I'm subject to taxes. Now, what if I got a loan on the building? Does that count towards?
Still X. So it's still what
So if I
that's
sold it for 1.3 or whatever they're telling me, I need to invest that. Even
1.3 less whatever the closing costs are. So if you spend, let's say, $50,000 in closing costs, that gets you to $1,250,000. You got to go buy some for $1,250,000. And then if you had a loan, you're either going to replace the loan and or come out of pocket with the difference in cash. Or if you bought less than that, you pay potentially taxes on the difference. How long ago did you inherit the property?
she's been gone 8 years, August, so about 7.5 years ago.
Yeah, so you're going to have some gain built into it for sure.
Because
Yeah.
everything went from me paying $3,000 for a year
Yeah.
to it shot all the way up, and I had to take somebody to get knocked down because they got
Property taxes, right? Yep.
So,
Yeah.
like 1250.
Yeah, there's been a lot of appreciation in the market in the last 8 years. I mean, the market has cooled off on the investment side a little bit. Prices are definitely down off their highs, but over the course of 8 years, you've seen a pretty significant
So
amount.
whatever I'm on a loan, I kind of take that on the chin and
Yeah,
what I sell.
yeah,
Yeah, so that's another thing that we look at before we say list your property now is, do you need to get a new loan? Let's get you pre-approved. Let's make sure you talk with a lender so that you understand what that looks like.
and they also may tell you to keep your property, right? So I've literally been on the phone with her. She's like said, I think you're probably better off just keeping what you have, which is interesting for someone that makes a living on selling real estate, but it's good advice ultimately, right? Yeah.
We're definitely like the lowest of pressure type salespeople.
Right. Yeah.
But anyways,
Yeah.
awesome. If anyone, I don't know if you guys have any other questions, feel free to stay, chit chat. I know it's like getting a little bit past where we thought we would end. So if anyone has to leave, you're more than welcome. If you want to chat, go ahead.
So if we have questions about selling one house in LA,
Yeah.
do we talk to you or you?
If you're talking about selling, if you have exchange questions, you can call me. But if you're talking about selling real estate and potentially doing exchanges, that is right there. Yeah.
What happens is once we're in escrow, that's when I call Greg. I set up the exchange. If you want to use them, you don't have to.
What?
But
After all that time? Jeez.
not wanting to
Wow.
use them, but it's not a requirement. As if you want to use them, it's not a requirement to use us. But yeah, we set that up during escrow with the 1031 exchange. But if you have specific questions for him, we can always, like, I've done conference calls where people have like very complex situations. We can do that as well.
I just want to say, Dana, Charlie, and Greg, thank you so much for being great.
Yeah. Thank you. You bet. You bet. You got it.